Okay, thank you, Mark. First of all, I would like to thank the organizers for inviting me here. It's always a great pleasure to be in Barcelona, even if this time my wife is here to monitor me and even my mother-in-law. So don't be surprised if I act a little different from usually. And I would like also to congratulate the Catalan Institute of Actuaries for their 25th anniversary. And today I'm going to talk about technical subject. I will try to make it interesting. And this technical subject was motivated by a real story in the French life insurance industry related to a change in longevity patterns. And because of this change in longevity patterns, we had to update our prospective life tables, as in many countries. And this generated some 8% increase in the present value of the liabilities on average in France. And the question I'm going to discuss today is, okay, it took us 12 years to adjust our life tables. Could we do better? Is it possible to adjust them quicker? And how to monitor, more generally, actuarial assumptions as quickly as possible, of course, under some false alarm constraints. Because if we react to any noisy observation, we might overreact, and this is, of course, suboptimal in many cases. So this is a joint work with Nicole El-Karoui, who is professor in Paris 6 University, and Yahya Sali, who is there, who's assistant professor in ISFA, in our department in Lyon. Maybe you don't know Yahya, so I just take the opportunity to show you some picture. He's a person who's not blue. And I was his former supervisor, so this talk is for me a kind of catharsis. So it's a way to apologize to him, because I was a very bad supervisor. So part of the talk will be a kind of story to apologize and to explain you how we got to this point. Because Yahya didn't like ruin theory. Maybe you know ruin theory, even if we're in a life insurance conference. It's supposed to model in a very stylized way the evolution of the surplus. We don't specify any accounting, okay? The surplus of a PNC insurance company over time. And of course, this was my primary field. This is also the field of some of my co-authors from Barcelona. But many persons think that, okay, this is useless in practice, and only few insurance companies use ruin theory in practice. So I was a bad supervisor because Yahya came to me and told me, I want to do a PhD with you, but I don't want to do ruin theory because it's useless. I want to be something useful. So I said, well, thank you. And because at that time we had started a research project on longevity with the reinsurer SCORE, and also with the International Labour Office about Latin America longevity. I thought, okay, let's do longevity. Then there's no risk to have any ruin theory. And then Yahya asked me to swear that there wouldn't be any ruin theory. And I said, of course, it's life insurance, it's longevity, so there cannot be any ruin theory. And another thing that I did bad with him is Yahya was raised and born in Agadir in Morocco, where the average temperature is between plus 25 and plus 30 all year long. And I invited him to Cornell University, where the temperature in winter ranges between minus 30 and minus 25. So you can see that he doesn't look very happy here. He had to quit smoking during 1 week. And then, after, let's say, 3 months of PhD, Yahya came to me and he was very upset because of these pictures coming up. And so, if you had to study this ruin theory course, before the SOA removed it from its program if you're in the US, then, well, you recognize in red some of those processes that look like ruin theory, in which you receive some premium income at some fixed rate, and then you have to pay claims, so your surplus goes down quite violently at each claim that you have to pay. Okay, so what happened? And I'm going to explain you what happened and to try to prove that I'm innocent, even if I should have known that this would happen. But PhD students tend to think that we know everything, but I didn't know the literature very well. I should have known, maybe, but I didn't know this literature. So here's the outline of the talk. I'm going to explain the quick detection problem in insurance. I'm going to explain you why Yahya was upset. I'm going to summarize some paper that we published last year in Annals of Applied Probability, in which we prove the optimality of some type of monitoring strategy that can be used in various cases, but of course in a very particular case. And I'm going to explain how to monitor populations in practice regarding mortality rates, but also surrender rates or other point processes that correspond to events where we count the number of events that occur. And then, if time permits, I will just show you 2 other insurance portfolios to convince you that there is some potential, maybe also in your companies or in your institutions, if you work in the industry, because we're always keen on trying to confront our theoretical method to practical grounds where everything becomes more complicated. So usually I use some blackboard, and when I came this morning, I was devastated because there was no board or flip chart. So I just drew some ugly pictures and took pictures and included them in my talk. So I'm sorry, it's a bit, it's not the best slides, but at least they're informative. So keep in mind this initial motivation that we want to detect an increase in longevity improvement speed, for example, for the French life insurance industry. This was the initial motivation. And at that time, I attended some research conference by Professor Shirayev, who is a well-known Russian mathematician. He lives now in the dacha of Kolmogorov, and he was one of his followers. He still skis and drinks vodka as before in the mass finance conferences. And he explained this problem that the Russians had during the Cold War and that Westerners had on the West side too. So basically, the Russians observed this noisy signal on their radar, and they wanted to be warned if the US wanted to send some nuclear rocket over USSR. over Russia. Okay, and they knew, according to some signal analysis, that they observed some kind of Brownian motion with no drifts, so on average it remains level. And if the predecessor of Donald Trump sends a nuclear rocket to Russia at time theta, then this corresponds to a change point. The new trend is this average trend here with average mu per unit of time, which is assumed in this Russian problem to be known. Of course, it's a strong assumption. And then the optimal problem they had was to react as quickly as possible. And so they were trying to find the optimal stopping time tau, which corresponds to the detection time, in order to minimize, well, this average detection delay, so the time elapsed between the time at which the signal changes and the detection time. They want to be able to send a few rockets to the US before dying as a pride, and they want also to try to destroy the rockets before they enter their space or while they're on Siberia. So you want to minimize this expected detection delay, but of course you're concerned with false alarm. Okay, you don't want to trigger nuclear war just because of an excursion of your Brownian motion that went a bit up further than usual. So this is why you are concerned with this probability of false alarm. In the Russians' model, they assume that the US will end up sending a rocket. They even have very often a Bayesian approach, which means that they have a prior distribution for this time theta. For example, very often they assume that theta follows some exponential distribution as a prior distribution. And then they're going to refine their estimation with what is called in actuarial science credibility theory, okay, so Bayesian techniques. And so what they used to solve was trying to minimize the expected detection delay plus a constant number times this probability of false alarm. Okay, and the constant number that's in front of the probability of false alarm, if you take it very large, then this means you're very concerned with false alarms. If you take it very low, then you will be very fast to react, and you have a high probability of false alarm. Okay, so this was the initial motivation. Then, of course, I thought about this life insurance problem that we had in France with prospective life tables. So here on the x-axis you have time. You have here something that looks like the Kapati in the Lee-Carter model. Okay, so the Kapati corresponds to a time series that's in most developed countries with a decreasing trend, very often with some autoregressive pattern, and that corresponds to the force dampening, lowering mortality rates at all ages with some beta x that modify this effect for different age classes. And so if Kapati starts to accelerate downwards, then it means that longevity improvements are going faster than it was before. Okay, and of course this corresponds to longevity risk, the awful risks that policyholders live longer than expected on average. And basically, the former prospective life tables were produced in France in 1993. It was called TPRV, Table Prospective pour Rente Viagère. And these tables had been designed by a former actuarial student. So you can imagine you have your master students, and one of them has to create the regulation for the whole life insurance industry. We changed in France. After that, we took a professor. I'm not sure the result will be better, but at least it seems a better process. Okay. So, and it's not the same person who became professor. So what the person who produced the TPRV 93 did, and this was not necessarily a bad choice, it's easy to criticize it now, okay, but this person took this long period, roughly 40 or 50 years before, basically up to the end of World War II, in order to calibrate the trend. And therefore, he calibrated this trend here, okay, because he averaged those two trends. Because here there was a kind of change point in the data with some longevity improvements speeding up. Of course, these changes are not so abrupt, okay, so I exaggerate a bit. Very often they are more smooth, and this is clearly one limitation of our work, to consider abrupt changes. And so what happened is that because the person used a period that was too long, and because there was this change point, well, longevity improvements continued as before, but from the change point, okay, onwards. And after 12 years, the difference in the present value of the cash flows, discounted, whatever that means, corresponded on average for the French insurance market to an increase of 8% in the reserves that was necessary. So, of course, the obvious question is, can we do better? And also, how to adapt the Russian school theory that works for Brownian motion, for continuous models, to processes that count number of events, like number of deaths, or number of surrenders, or number of accidents in number of claims in P&C insurance. Well, of course, there's a first question. Remember, the Russians had some information about the new trend that would occur if the US sent them some nuclear rocket. Of course, if we're afraid of an increase in the speed of longevity or in the level, we don't really know what the new trend, the new improvements rates, or the new levels will be. So one question is how to choose the equivalent of this new trend mu, okay, because in this theory we must specify one. So from my point of view, this choice corresponds to the notion of risk tolerance or risk appetite, and is related to the concept of key risk indicators in enterprise risk management. What is a key risk indicator? It's an indicator that helps you to give you an early warning, and it to be efficient for decision makers, for top management. It must be associated with a proposed reaction, because the top management is not interested in having just red lights popping up, okay? They want to have red light associated to this might be happening. By default, you might want to do this, or not doing this, or wait, or do something else, but at least to have some proposed reaction. And therefore, this new improvement rate level or mortality level should be associated to the level at which, well, top management would need to do something. For example, change the asset allocation, take more risk on the asset side, or at the government level, at the national level, it could be increasing the retirement age or some other management action. And very often, for us actuaries, it's in fact very hard to communicate with top management, because very often we explain what happens if longevity improvements are doubled, or what happens if the mortality level is in fact 80% of the forecasted mortality level that we use, because we have a pension fund with 5,000-10,000 persons, and we had some uncertainty on our mortality level. Even if there's no change, simply there is estimation risk, and we might want to detect that the mortality level we choose is not the right one, that it's in fact much lower, and so longevity is much higher. So if we say that, well, very often the chief financial officer and the CEO, for them it's just actuarial language, and they're a bit lost. At least they don't really pay attention to this kind of risk, if you want. And IAA produced this table when we came to see some pension fund in Switzerland. And in fact, this slide attracted very much the attention of the CFO and of the CEO, and helped them to position themselves and to formulate some kind of risk appetite that helped to calibrate and to choose this level rho. And so what do you see in this slide? You see, for example, for a portfolio of Swiss women at age 65, for this pension fund, if we make some error in the mortality level, okay, so roughly a 20% error on the mortality rate, then this corresponds to underestimating the pension value by 4.7%. Okay, so even the CFO was still a bit uninterested. And then IAA added this to compensate this technical loss. On the investment side, you should get some alpha, so some extra return, equal to 36 basis points every year to compensate for the technical loss. And this was much easier for the chief financial officer to appreciate, and this helped a lot the chief financial officer and the CEO to understand and to measure on their own scales the actuarial risks. And so on top of this topic, I think it's very important for us actuaries to use this kind of equivalence, even if we know that they are not perfect. For example, here, something might have shocked you, okay? This flat interest rate of 3%. Of course, now it's much lower, but we had to choose this value for some reason at that time. But still, even if it's not a perfect equivalence, it helps decision makers and CFOs to appreciate the size of some technical risks, for which sometimes they have difficulties to measure them with their own scales. And then the CFO noticed that if the portfolio is composed of people that are slightly older, then, well, there's a need for more basis points to compensate. And then the CFO was even more interested because he was thinking, yeah, but because I have 10 years less to achieve this investment and this overperformance, it's even harder because you need more time if you want to overperform on the financial side. So then the CFO understood not only the size of the risk, but also that there was a need to monitor this risk, because otherwise it could quickly become under control and have some kind of amplified effect when you compare it to financial risks. So some literature, all the papers I should have known, and then maybe Yaya wouldn't be in this room, maybe he would still work for SCOR or for AXA or some other company. This is the literature about sequential testing or quickest detection problem. So all those people already thought about this problem to detect as quickly as possible a change in some data. Okay. First, for the Brownian motion, Page and Shirayev, as well as later on Bible and Mustakides. And then some people considered this problem in the case that we're interested in today, which is the point process case in which we count number of events. So in the Poisson process framework, very often there was some Bayesian approach. So people used some prior distribution on theta that was of course arbitrary and very important in terms of results. So if you change this prior distribution, you get completely different results, which is not, of course, acceptable for monitoring. But there was this paper in particular, all the school by Gapef and Bayraktar and Dayanik, who worked on this problem in a Bayesian setting. Here, I introduce the mathematical framework. You don't need to have a look at all the notation, only a few things are important. And if you haven't done mathematics for a long time, don't worry, I will try to explain the most important things. So the way we tackled the problem at the beginning was that we assumed we had a kind of reference national population. Why? Because if you think about this prospective life tables here, when Daniel Seran produced these tables, he had 19 insurance company portfolios from France that he could merge. But even after merging these 19 insurance company portfolios, it was not enough to produce some prospective life tables without any relation to national population table, namely the French national population table. So very often, if the pension fund size is small or if we have a subpopulation that is not large enough, we use a reference population which corresponds to this mortality intensity lambda 0, and we have some multiplier rho that could be, for example, 80% or 60%, which means that mortality intensities are 60% times the mortality, for my pension fund, is 60% times the mortality intensity for the same age at the same time for the national population, okay, due to selection effect and other effects. So here the change point detection works this way. Remember this times theta at which things change, okay? This theta is unobserved. You don't observe theta, otherwise it would be very easy. But before times theta, the multiplier is rho under bar, and after times theta, it's rho bar, okay? And without loss of generality for the mathematical part, it's only 2 slides, we'll assume that we start with a multiplier of 1, okay, it doesn't change anything. And I will concentrate for 2 slides on the mortality case. Because you see here, if rho bar is larger than 1, this means that we're interested in detecting an increase in mortality rates. And of course, if we have some pension portfolio, then we are interested in the case rho bar is less than 1, because we are afraid that the multiplier becomes smaller. But I show you the results for this case first, because it's the case where it's the most difficult from a mathematical point of view. So how can we adapt this Shirayev framework? Well, there's another optimization problem that was formulated by Lorden. And Lorden formulated a problem that's slightly different from the one of Shirayev. If you remember, Shirayev wanted to minimize the expected delay plus a constant number times the false alarm probability. We're going to change this. We're going to say, I fix the false alarm constraint. So I don't want to go to my boss or to go to the government and sound an alarm, a false alarm, more than once every 50 years, 100 years on average. Okay? So I choose a constraint. Depending on your boss, you can choose how often you can disturb your boss with a false alarm. Okay? This depends on you and on your boss and on if you want to keep your job. And so once you fixed the false alarm constraint, saying, I don't want to do a false alarm on average more often than once every 50 years, then you want to minimize the expected number of deaths between the event and the detection time. Okay, so instead of looking at the detection time, detection delay, we look at the number of events between the time theta and the detection time. And in fact, we were lucky when we designed this new criterion, because to be honest, we designed it because we thought it made more sense for the insurer point of view, particularly in a P&C world where it depends on how many claims you have before you react. And in fact, this change in the criterion was wonderful, because it's a right adaptation to be able to generalize this solution to a case where we have a population. Because when we have a population, if we want to be very careful on the mathematical side, after the death of one person, well, there is one person less exposed, right? And so, of course, if we have 1 million persons, this is not going to change everything. But if we have small age groups, then the fact that we have one person less in the exposure might be important to take into account, to be precise. This is, for example, why Lee and Carter designed the Lee-Carter model primarily for the central rates of mortality, in which you try to use the average exposure instead of the initial exposure at the period. Okay, so the goal is what? Well, it's to try to solve this problem. It looks a bit ugly because of the mathematical formulation, but I can read it in English with a French accent. So what you want to do is to find the best monitoring strategy. So you want to minimize in terms of tau, which is all the monitoring strategies you can choose. You want to minimize the expected number of deaths between the event and the detection time in the worst case scenario. Because here you see you have some essential supremum over all possible small omega. So it's a worst case that could occur. And there it's also the worst case depending on the time at which this occurs. So this means that you want to react very fast if this occurs tomorrow, but you want also to react very fast if this occurs in 20 years from now. You want something that's not going to be very bad if things blow up today, or very bad if things take 20 years before blowing up. So you want to be good in the worst case scenario, and this is why this approach is called robust detection, because it's not sensitive to any prior assumption on theta. So even if you take the wrong new parameter, or even if you make some slight simplification in your assumptions, this monitoring process will still do good. Maybe it will not be the best one, but it will probably do very well in presence of this slight imperfection. Okay, so you want to minimize the number of deaths between the time at which the change occurs and the detection time, under the condition that, well, you have on average a certain minimum number of deaths before you do the false alarm, which corresponds to having, let's say, 10, 20, 50 years on average before the false alarm. And we have two assumptions. The first one is quite reasonable. It says that there is on average a finite number of deaths on every finite time interval. So we are fortunate that it's the case, of course. And here, this second assumption is, of course, more restrictive. You need to have observations coming up all the time as time goes by. So you need an infinity of deaths when time goes to infinity, which means that you cannot use this method for a closed pension fund, for example. If it's a closed pension fund with 10,000 persons, then the number of deaths up to infinity is 10,000. It's not infinity. So this monitoring strategy is designed for portfolios that are not closed to new entries. And if you want to apply it to a closed portfolio, you need to make sure that the extinction time of your portfolio is long enough to allow you to use this method, even if it's not then perfectly justified from a theoretical point of view. Maybe you can still do it. And here is the explanation why Yaya could be upset with me. Because if you look at this so-called Radon-Nikodym density of the two probability measures, the one in the new world and the one before the change, so this corresponds to a kind of likelihood ratio. Okay, you compare, given your observation, the likelihood that things have changed versus the likelihood that things have not changed. Okay, and if this process is up, it means that it's very likely that things have changed. If it's low, it means that it's very likely that things have not changed. And here you see it's equal to exponential ut. And if you have a look at this u at time t, it's log of rho. Here this is positive because we took rho larger than 1 times n of t plus 1 minus rho times, and this integral would be lambda 0 times t if lambda 0s was constant over time. And this is negative because rho is larger than 1. So that here you recognize this kind of process with a negative drift, this rho minus 1 times t, and upward jumps of size 1, of size, log of rho. Here, log of rho times n of t is like the sum of, for k from 1 to n of t, of log of rho. So it's a dual ruin theory model, exactly the model that Yaya didn't want to consider. This model immediately occurs as soon as you want to compare the likelihood that things have changed with respect to the likelihood that things have not changed in the case where you have a Poisson process, which is the starting model, the easiest model to count number of events in insurance. Okay. And of course, if rho is less than 1, then you have the other picture with an increase over time and downward jumps, exactly like premium income rate and claim amounts. And the results that we have shown in the paper I mentioned earlier is this one. If we design some false alarm constraint, then we can show that the optimal strategy is given by monitoring the so-called Kusum process, cumulated sums process. And this process is called Vt of x. It's not exactly ut. It's in fact the process ut, but reflected at time 0. So I will show you on this picture. You start from 0. Your process u of t, remember you have rho minus 1 times t, so it goes down. But here, instead of going down like this, you reflect this process, so you don't allow the process to go down below 0. Then there's a first claim, so you go up by 1. Here it's rescaled such that log of rho is 1. And then you go down and so on, you go up. And each time you reach 0, you reflect the process in order not to continue to go down. Okay? And in fact, it's very, so we have shown that this was the best monitoring strategy in the precise optimization problem that we formulated. Okay? So in particular, it overperforms the naive methods that would be a kind of moving average, where most actuaries would simply, in a very reasonable fashion, monitor either the average number of claims over the last 3 months or the average number of deaths over the last 3 months, accounting, of course, for aging and change in exposure. Okay, so here, this result tells you that this strategy is faster, for example, than the moving average strategy. And even if the formulation, the mathematical formulation seems a bit technical, even if proving that it's optimal in that particular case is a bit difficult, using this strategy and explaining it to a board of directors or to top management is much easier. Why? Because it's in fact very natural. Each time here you have a claim, you go up. So here you see up to times 3, nothing changes. And so your key risk indicator, this red process, well, goes on average slightly down. So because it goes slightly down on average, by the law of large numbers, of course it can go up, but it's very likely that it will remain very close to 0. You see here it goes a bit up, but then it comes back gently to 0. But then after times 3 here, the number of events per unit of time increases. So it's like as if mortality rates suddenly increase. And then, well, there are now too many jumps for the process to remain low. Every time there's a jump, it goes up. And then after the change, on average, the process is very likely to escape upwards, because there are too many jumps and too many deaths, and the downward drift doesn't manage to bring back the process to 0 anymore. And therefore, here you define some threshold here. We're going to see how to define this threshold. And tau m that you've seen before, if m is 6, tau m is there. It's the first time at which your red process overshoots, goes above the level 6 for m equals 6. Okay, so it's very easy to explain to the top management by the fact that if there are more deaths or more claims, then well, your process will go up. And then you just have to explain that it's a way, from a statistical point of view, to monitor things and to define a threshold for which, after you cross this threshold, statistically, in absence of any information, and this is of course very important too, in absence of any other information, you could conclude that something has changed according to the statistical decision-making procedure. And here, for the right-hand side picture, it's the opposite, okay? You want to detect a change towards more longevity. So this time it's the opposite. You see that the process drifts upwards, and up to times 3, you have you have the expected number of deaths, so that the process comes back, stays very close to 0. But after times 3, longevity improves, and you don't have enough deaths now to bring the process back to 0. So therefore, the process escapes upwards, and you don't have enough deaths to bring the process back to 0. In practice, it's a bit different. You have to adapt your method to monitor populations. Why? Because the intensity is no longer constant over time. Because of aging, your population is aging over time, so that mortality rates and mortality intensities is continuously increasing over time. Okay, you see here the intensity increasing. And then here you have a death. So your monitoring process goes up and start to go down. But here for your intensity, because you have one person less, because one person dies, you have a downward jump in your intensity. Okay, so each time there's a jump, it decreases the death intensity. We say that it's not a self-excited process as the Hawkes process, but it's a partly dis-excited process, because every time something happens, there is a decrease, a slight decrease in the intensity. And then you have aging again, so your monitoring process goes down, reflects, and then there is a new entry in your portfolio. New entry, well, there's nothing in the monitoring side, but it increases the intensity because you have one person more. Of course, the increase is much lower, okay, but I exaggerated it on this slide. Then more aging, and then death. So death means upward jumps for the monitoring process. And what may happen if you have a very small population could be that in some cases, for some age classes, for example, it could be that everybody is dead in the age class. Otherwise, if it's for the whole population, the actuary has no problem anymore. But maybe in the age class, there's nobody left. In that case, the intensity is 0 up to the next entry, and the monitoring process remains level before the new entry and starts to decrease again. Okay, so because of this, you have to, in that case, to account for this history of the process and for aging, which will change the intensity over time, and our result remains valid. But of course, a few things need to be computed in a more delicate way, because we must account for some time change that's sometimes stochastic. So how to use it in practice? Well, first of all, you fix the input parameters. You estimate your parameter on a trained set of data. Then you specify rho according to your risk appetite. And then you're going to have the top management choose the level M, the level of the threshold. And then you just monitor your process. I will skip this observation to go directly to the second example, which is with simulated data, and after that we'll go to real-world data. So the first example, we come back to this Swiss pension fund. Okay, in this Swiss pension fund, you have roughly 5,000, 10,000 pensionees, and we want to test a misestimation of the mortality levels. So we want to check that the mortality levels are not 95% or 90% of the ones that is in the actuarial model. And so here you can see some simulations, and there are in fact two possibilities, and in fact more possibilities. First possibility, you put all the age classes together. This corresponds to monitoring the black key risk indicator. And then in that case, because I applied the same shock to all age groups, of course, it's the optimal strategy to consider all age groups at the same time. If you consider only the age group 76-90 years old, it's a blue risk indicator. You see that it takes you a bit more time to detect the change, simply because you don't use all the information you have, and in particular, you don't use this mortality indices from age group 60-75. If you use the red index, you see that you don't even detect anything up to the end of this time frame. Of course, if it was the opposite, if improvements only concerned, let's say, the age group 76-90 in blue, it would be less efficient to use the black curve because it would take longer, because you would dilute your observation with irrelevant observations from age groups for which nothing changes. Here, you can see that if you fix monitoring parameters, let's say, in accordance to practice in reliability theory or other fields, you would basically detect a 10% change or a 10% overestimation risk of your mortality rates for a portfolio of 5,000 persons within 1 year. Which seems like a miracle, right? Because you have a small pension fund of 10,000 persons. You use this and you would be able to detect a 10% change in mortality rates within 1 year, on average. Of course, when we show these figures, it's in analogy with other fields, with other constraints, but I don't specify here the false alarm probability. In fact, in that case, we would detect this after 1 year, but we would make a false alarm every 3, 4, 5 years maximum, on average. So it's, of course, not acceptable because it's not useful for decision making. The false alarm probability is too high. Therefore, you can see that it's necessary to engage the risk management and the top management by showing not necessarily the full curves like this, but showing maybe 3 points on those curves to explain top management that, let's say that they want to detect a change of 15% in the mortality rates. Well, if they want to have a false alarm, let's say every 30 years, then it will take roughly 3 years on average, 3.25 years on average, to detect a change. But if they want to be quicker, then they would have to accept that basically here you get something that is very convex. So if you're too impatient, well, you can't really discriminate between false alarm and real detection. So after specifying the risk appetite parameter rho, it's necessary to explain the top management that, okay, if you want to detect something within 5 years, roughly you will make a false alarm every, let's say, 40 years. But if you want to detect something within 1 year, if it changes on average, then you will make a false alarm every 3 or 2.5 years. Then immediately when they hear this, they understand that they need to wait 4, 5, 6 years to detect something. They have to accept it, because otherwise you lose some power, and the false alarm becomes more important. And of course, if your change is very small, for example, if you change by only 1%, well, you can see that here the convexity is there, but it's in fact very light, and so you can try to detect this only if you have a very, very large portfolio, or if you have a lot of time. But in many cases, a 1% change is not something that worries you, except for very competitive lines of business. Maybe in P&C, that's true that this change could be sometimes a problem for very large lines of business. But for pension funds, very often it's more 5, 10, or 15% at the scale of mortality intensities that corresponds to a shock that you want to monitor. And I will conclude with some real-world data. It's a data set from 14 real-world life insurers. Some of them are exposed to mortality risk. Some of them are exposed to longevity risk. And everything is mixed up, okay? Not all the data sets, but I mean, we have insurers from the two types, and we have insurers that also sell both products. So here you get the age pyramids, okay, for females in red and males in blue for each insurer, and in black here, this is the average overall age pyramid. Okay, so it shows you that we have some heterogeneity, various risk profiles, and very different products. And in addition to this, we also have insurers who sell products to people that are more rich than others on average, and you have also some of those insurers who sell products to the average person in the street, or to someone who is on average more deprived than an average person. So here, the first thing that we can try to do is to have a look at mortality levels, the position of mortality rates in comparison to the overall mortality. And if you have a look at these numbers, you can see here, so remember, red is for females and blue is for males. You can see for each insurer, here it's insurer number 11, portfolio 11. So you have here on the whole period, you have these numbers. Here this is on the training period, and here this is in the following period. Okay, so here for this insurer, you go from this level to that level. Of course, it's an insurer with a very small portfolio and very few deaths. This is why you have such a big variability. Okay, but for some others, you can see also some variability that occurs from one period to the other. And here, this is how pictures look like for the monitoring processes for the different insurers. So of course, when there's missing data, there's nothing. And each time, if we see that empirically we had an increase in the mortality rates, we monitor an increase in mortality rates. If we see that we have a decrease, we monitor a decrease with rho less than 1. And we chose a change by 8%. This means that we want to compare the fact that in the previous model, well, we have a multiplier of 1 with respect to the new model after the change, if the change occurs, in which we have a new multiplier that's 1 plus 8%. When we have a decrease, like for this insurer 11 that I mentioned, then we chose this new multiplier to be 1 minus 8%. Okay? And when we do that, we can see different indicators. So of course, in many cases, this indicator is informative, but we don't really need it because it is so obvious that something occurred. And in particular, here, you see the realized value of the multiplier is 1.29. So here, of course, it's very logical that the Kusum process goes up. Here, the realized multiplier is 0.42. So of course, it's very logical that this indicator blows up. Okay, we don't need this kind of thing. When is it useful to have a kind of objective criterion? For example, for insurer number 10 over there, where you see that the realized is in fact exactly 1.08. This is by chance. This is not on purpose. And here you see that there is clearly the threshold should be between 15 and 20. So there is a clear detection, even if the process doesn't really blow up, it then remains between the two. So in that case, this is of course a fuzzy situation, but this is exactly the kind of situation where you need some kind of tool to decide whether something happened or something hasn't happened. At least you can't confirm that something has happened. And just 2 examples of P&C insurance portfolios to show you that this is not limited to life insurance, but it can be used for various types of risks. Here for this P&C portfolio in which there was an increase, you can see that the Kusum works quite well and we detect something. You can see that if here it's quite dependent on the threshold, because if we put the threshold slightly higher, we would detect, let's say, 1 or 2 months after detection time, we would detect there. But the detection is quite clear. And for this other portfolio in which we have a certain number of claims, well, it was supposed that there was more a decrease in the claim frequency, and the Kusum process remains at a low level in spite of some slight movement here. It remains quite low. So I mentioned at the beginning in the first slide some Lolita project on the logo on the bottom right hand corner. Lolita stands for longevity with lifestyle adjustments. It's a research project funded by the French National Research Agency. It involves 29 researchers from Lyon, Paris, and other universities. And this project it was a 4-year project. It's going to be finished beginning of 2018. And so we have a conference, closing international conference in Paris for this project. And if you're interested, you're welcome to attend or to submit a paper. In that case, you just email me. And in this conference, we will talk particularly on these detection problems as well as the modeling aspects of populations and try to take into account not only mortality rates but population dynamics, because we've seen that birth patterns and birth irregularities in the works of Alexandre Boumezoued or in the works of Andrew Cairns. Well, irregular birth patterns might give you some fake cohort effect, and that it's very important to understand the whole structure of the population, not only mortality rates, even if the insurance and pension industry has focused on mortality rates, because sometimes we acquire customers after the age 30, 40, 50. But still it's interesting to take into account the composition of the population. So this conference will be about this topic, and we'll try also to produce some lecture notes that will be available on the Longevity and Lolita website. And I will then, as soon as we have new papers, remember to put them on Hermano's website, because I listened carefully and I was very interested in your initiative. So I will stop here. Thank you very much.
Okay, very interesting conference. Now, well, we begin with a round of questions. Are there any questions? Okay, there.
Yes, yes, I attended. Yes, I attended some section here, and noticed because of good jobs that as always, at the necessity to learn from the past and project to the future. So learn to the past, yes, and project to the future, and create models and so on. Sophisticated models, plenty of mathematical formula, but I am not an expert, but I think it is possible to introduce in this model concept of machine learning, for instance, because a model is a machine, not more. No, yes, what? Sorry? A concept I think into the scenario of intelligence, artificial intelligence, there are two steps. One is machine learning, is the first step, and the other deep learning. That they say on neuronals, yes, and so on. That is absolutely other step and more complex. But in a first stage, because I think that what could be well if the own model take decisions. There are two ways, or you run the model in a global run. You should know global run is pass over the population. The own model take decisions. So is one estimate. And you follow the model and stop, yes, at the decision. Another that still at the decision, or define what surrounding the model, and is the other model who take the decision. Yes, I don't know, because I am not because I am not an expert, no? But I think perhaps is a way for investigation. Well, just what do you think?
Yeah, so that's a good that's a good point, that we have more and more information. Here, what I presented is when your only source of information consists in the events. But of course, to make this kind of decisions, many other sources of information are important. In particular, advances in medical science. It could be also combining different databases. And for this, of course, recent, I wouldn't say advances in machine learning, because it's still the same techniques as decades ago, but at least the fact that it's possible now to get big amounts of data and to have the computer power to analyze them, of course it's very important to take this into account. So for example, in several countries, the social security database starts to be available at least to public researchers like us, at least in theory. And so we have people in our lab who apply deep learning and machine learning to try to do two things: to refine mortality longevity forecasts, and also to do some drug repositioning, or to find insight that can help to say, well, if you take this kind of drugs that was good for diabetes, in fact, it's also good to prevent some types of cancer, according to some statistical analysis. And then, if it's reasonable enough, you might want to reposition these drugs to treat some, or to have some preventive care. So in that case, getting insight from these big data sources is very important. And I know that there was some studies by level of deprivation made by Andrew Cairns. I don't know if Andrew is still there. There was also a study on UK data by Héloïse Labitardi. I know that Héloïse should be around here, yes. And so these studies start with, I would say, a few indicators of affluence or other wealth level obtained from big data sources. This is the first step. But then the next step will be to use bigger databases. And then, of course, thinking about optimal ways to detect changes using this information. It's a much more challenging question. I don't know how to do it, but it's one of the challenges. And tomorrow, Anani Olympio, who is up there, will present some analysis of longevity model risk, in which you combine expert judgment from different groups, including transhumanists, who claim that, like Aubrey de Grey, that persons who will live 1,000 years already exist. So in that case, maybe you want also to monitor, maybe not as extreme statements, but some weights, credibility weights to different assumptions that scientists could make over the longevity, and at least the ones from Vopel that say that the best practice line will continue, and the one with demographers like Olshansky who says there's a maximum biologic age that remains constant or that increases very slowly over time, and that is likely to produce some rectangularization of survival curves. So with deep learning, as you mentioned it, probably one application could be in the next 5-10 years to mine health databases to mine health databases and to try to detect these changes in mortality patterns. But it will be more complex to find optimal strategies.
Any other question?
Your analysis supposes a discrete change in the parameter value at a single point in time, which you're then trying to detect. Have you considered a more gradual change in the parameter over an extended period, and does it change the analysis results at all?
Yeah, so we We didn't try to prove the optimality for a gradual change, basically because we knew that there was very little chance that we would succeed. But what we are doing right now is to analyze the performance of this strategy in presence of a gradual change. And the goal is to try, we haven't obtained this kind of result, but the goal, if we have time to do it, is to show that this algorithm performs not too bad if the change is gradual according to the convexity that you have, if it's quite convex, to show that we don't do too bad with this kind of algorithm. If you have a gradual change on general, Bayesian methods typically works better if you manage to locate the change point easily. But in the most interesting cases, you can't really do it. So online, you can do it offline, but online is more difficult. So we can hope to get some robustness result, but I don't believe that it's reasonable to try to look for optimality results. At least not with our methods.
More questions? Okay, so we finish here the conference. Thank you very much for